This is the Stock Trend Reality Podcast, episode 182.
So just be aware of your surroundings, and that instantly makes you better than the average trader.
This is the Stock Trading Reality Podcast, where you get to see the realistic side of a trader's journey. Get inspired and stay motivated by everyday normal people who are currently on their journey to trading success. Clay Trader.
Hey, it's Clay. Hopefully you noticed by the thumbnail that this is a part 2. So if you want to get the interview to its full effect, make sure you go back and listen to episode 181 first, and that'll give you kind of the whole timeline and just make the entire discussion flow the smoothest way and the way that it should. So without further ado, let's get back to Mike and his journey. Remember, this is part 2, so be sure to listen to episode 181 first. But if you've already listened to 181, then let's go and finish up my discussion with chat room member Mike.
Okay, so I've gone through my story, which I've gone through a lot of different areas in my life, and so I thought the next thing we could talk about is basic strategies as to what I do that's helped me be successful. That is one version of many that'll hopefully give you some ideas of how to think about trading in maybe a different light other than looking at the chart and stopping there as a story. So I have a few basic strategies I use. First of all, we throw around the term Kool-Aid quite a lot, and you hear it in many different chat rooms. You hear it when you talk to investors. You hear it in corporate America too. And everybody that understands how a chart works tells you that you should never drink the Kool-Aid per se. And so I'm a big fan, though, of you should, if you're going to understand what Kool-Aid is, you should sip it, but so you remember the taste, but that doesn't mean you chug it. And what I mean by that is when you're looking at a chart or you're looking at movement on a market, you should understand at a macro level why that movement is happening before you even take a look at the chart. And so a few things I do before I even start the day is I always scan the news. And I think if you scan the news, that gives you that realistic basis, again, that grounded realism as to what's taking place in the market. And so that means knowing when your earnings are occurring on a certain stock, and you'd be floored with the number of traders that have no idea what an earnings cycle is or what a 8K or a 10Q is on the market. And again, that doesn't mean you need to go through and be an expert in financial statements, but it does mean that you need to understand how earnings drive a market. And that's not the revenue or the EPS number that is shown on CNBC or on Fox Business. It's the forecast going forward. Because remember, stocks are valued based on the future. If they're valued on today's actual amount, so we would just take total assets and take out the liabilities, and that's your value. But it's more complex than that. Tesla is a good example of that today, something that trades at 200, 300 times earnings, or Amazon, but they trade that high because of the promise of the future, not the balance sheet today. And so understanding
I want to ask you this
value.
Sorry. What are your thoughts on Tesla? Are you a Tesla bull or a Tesla bear?
Right now, they closed at, I don't remember the exact price. They closed around 310. So at this point, I actually have strangles on Tesla at, I don't have my chart up. I think it's around 270 and 390. Okay. But the bang for the buck that I'm getting on that versus the news cycle of Elon Musk potentially taking Tesla private, and I don't want to get into that because that'll be a 2-hour conversation, but taking it private at 420 versus the discount that you're seeing on the stock price at 310. And we're almost 2 weeks since those tweets. It's hard to argue that you could be a Tesla bull for any price over the recent highs, which is 380, 390. And if actually you're talking me into another thing I'm going to get into in a moment. On the flip side, if I remember correctly, Tesla hasn't tested below 270 in a long time. That doesn't mean that can't happen, but it would take something egregious for that to happen. Elon Musk getting checked into a mental hospital would be a Kool-Aid event or a Six Sigma event where that could happen, or a Black Swan event, same thing. But the point being that if you look at what's taking place in the news cycle, you've got Elon Musk talking about taking Tesla private. He doesn't have funding, although he has potential sources of Goldman Sachs, and I forget what the second bank was he was talking to, but he has potential sources versus the chart. The story versus the news cycle don't add up. And so the Kool-Aid's telling you, everything's fine, and the chart's telling you the sky isn't quite falling, but there's thunderstorms in the area. And so if I take that in another example, I'd mention you should always scan the news. And so in scanning the news, if you look at Bloomberg, this is Saturday, August 18th, you'll see on Bloomberg, the head story at the moment is Tesla board torn between service to shareholders and CEO. That to me is a red flag right there, because the boards generally serve shareholders in the company, not the CEO, even though the CEO owns about 20% of Tesla. But that's me as a corporate governance practitioner. And so you start adding up all these facts, and then if you were to go look at the chart and Tesla is trading around 310, there's a lot of different trades you could put in. And even if you're not bullish or bearish, if you understand how to trade options, going back to that continuous learning, that grounded realism, there's a lot of plays you could put on Tesla this weekend. I'm probably going to do this after we're done here, to go shopping for people that can't do math. And I'll talk about that here in just a moment. Or people that don't understand news cycles, which we're talking about now. And so for me, you should always scan the news every morning before you even open your trading platform. So that's CNBC, that's Bloomberg, Fox Business, Wall Street Journal, Financial Times. There's a ton of them out there. I'm also a fan of Real Clear, because they go through and aggregate 10 or 15 different websites, sometimes more, and put them into different areas you would see in a normal paper: markets, energy, politics, sports, world, whatnot. The other thing you should look at too is what's taking place in Washington, because they set policy for what takes place on the market. And that's not to make a political statement, but it is to state that if there's political news that can impact the market, you need to be aware of it. And that's just not what happens on Capitol Hill. That's also what happens with the Fed. That also is what happens in certain departments, the Department of Energy, Department of State, and so forth. And so if you keep your eyes on those, and I'm not suggesting that's 2 hours, I am suggesting maybe that's 15 minutes out of your day, then I think you'll find before you open any charts, you'll be much more educated, much better positioned to put trades on that will help you in becoming a more profitable trader, regardless of whether you believe in stop losses and profit targets, or if you just shove all in on one stock and hope for the best, asking your magic 8-ball. At least you'll have a chance.
Now, just for clarification's sake, this is all more from how you do it from a swing trading perspective. I do what you say. Every morning, that's part of I like to scan the headlines. But an earnings cycle, what you're talking about, to go back to your earlier example, if you're trading the 5-minute chart, this stuff, I'm not going to say doesn't matter, but it doesn't matter nearly as much as if you're going to do something like putting on a swing trade. Is that what you're getting at pretty much, is more so from a swing trading type dynamic?
Well, so I think it matters for all investors. So in an example where, let's take Tesla again. Let's say that Tesla has no additional news and it opens at 3:02 on Monday morning. Okay. If you're a 5-minute chart trader, you're looking for one of two things. If I were doing this, an absent level 2s and absent all patterns. If it tries out 300, that's a great place to see if you can play what I'll call a reversion to the mean trade, or a rubber band trade, where it may try out 300 and hold, and then it's going to shoot up. Likewise, if you're bearish on Tesla, like we were talking about, absent the news cycle, if it breaks below 300, it's going to fall for a while. Right. And so how you would judge that before you even look at a Tesla chart is to go look at the news and say, was there any additional information outside the chart I need to be aware of before I put that trade on the open? If there isn't, then that's purely a technical candle trade at that point, which is what is taught throughout the room. If I'm a fundamentalist, then especially if I'm an option or a premium seller and It happens to be earnings day, you would be nuts to sell options 5 minutes into an earnings cycle, right? Now, if we go 4 hours, you get past the release of the earnings, you get past the analyst call, and the price starts to settle down, then that's a great place to play. But my point being that no matter what strategy or time frame you're using, you should be aware at a high level of what's in the news, and then you go. Now, does that mean that you read 20 analyst opinions and then you go put on a nice, neat risk versus reward trade on Tesla on 8:31 a.m. Central? No, and I fully agree with you there. Once you scan the news, the story is in the candles, right? So that's a strong form of efficiency market where after 10 or 15 minutes, the market's priced in all news, both public and private, right? In my view, if you're a swing trader, a semi-strong form, then the market prices in all public information, but you also need to be aware of what else is taking place outside the market to put those trades on. Right. And it's not that should affect your risk reward trade-offs, or it should affect stop losses or price targets. It's more an awareness as to what's taking place on the market. Because the other reason you do that is as the market goes through the day, if I'm trading Apple as an example, and I know that, and I'm pulling stuff out of the air now, but if Qualcomm is providing parts to Apple and Apple announces that they've got this new product coming through, or they've got this higher earnings, or they adjust earnings forecast, then you may miss the boat on Apple, but Qualcomm's something you go take a look at because they're selling to Apple, right? So just because you missed a boat on one stock doesn't mean that there's a correlated stock that you go pick up, which to me is why it's so important to understand what's in the news at a high level and how companies correlate with each other, which we're just starting to get into.
No, that makes right, good sense.
Yeah, so that's one. The next thing, and this is something I've tried to do over the last few years, is to be observant around you for trade ideas. And what I mean by that is that you're surrounded by businesses all the time, both public and private. And so what I've learned, and this is more of a swing or even a fundamentalist trade than as a technical trade, because if you go into Gap and you can't find what you're looking for because the shelves are screwed up, that's not going to be priced into the market the next morning, but it could be priced into the next earnings cycle. And so as you're looking through, I think you call them your money tree. And I'm sorry, I haven't taken those courses, but if you are looking at investing in an IRA or Roth or something that's a buy and hold strategy, as you're looking around and seeing how businesses run, if you see things that just don't make business sense, those are businesses you should probably stay away from or short if you can do that. And likewise, if they're just clean, they're very silent running when you walk in, think an Apple store as an example. There's a lot of chaos in an Apple store, but when you look at the processes around an Apple store, it's pretty clean. They know what they're doing. When you look at a Microsoft store 3 years ago, that wasn't the case. Today it is. When you look at those stores, there's a reason they trade at premium prices, and it's because they know how to make money quickly and efficiently. And so if you're a swing trader or you're a fundamentalist, I would challenge you to start looking around your observable world and start looking for trade ideas before you even start beginning analyst research or looking at charts or whatnot, because that sets your mind as to whether a chart is set up based on that investment thesis or whether the chart is already priced in everything you see and there's no money to be made there. Yeah, so if you're chasing Apple right now as an example, which I haven't looked at an Apple chart in a while, but I'm guessing it's at 200, and that's an all-time high for Apple. That's probably not.
Let me actually, yeah, you really haven't. Yeah. It's at 217.
217.
Yeah.
So if you're a fundamental investor, 217 is probably not the place you want to get in when it's sky high and starting to head for Mars. But if it came down to say 211 or 201, maybe that is where you want to get in. And again, that's for you to decide as you're an individual investor, because I don't know your situation. But the point being that as a fundamental investor, you're looking for pullbacks to get into the market on good companies. As a technical trader, you may open Apple and it's at 217, and if it happens to have heavy volume to the downside, then you've got a decision of whether you want to try to ride a rebound in a mean reversion trade, or if it's sinking for the bottom of the ocean and you want to pile on a couple of tons of steel to help it get there faster. And so being observant around your environment, I think, helps the trader as well. And then knowing the macroeconomic calendar is the other thing. So when Fed minutes come out, if you invest in oil, knowing when inventories come out, knowing manufacturing indices if you invest in heavy manufacturing or traditional blue chip, think GE again. If you invest in currency markets, knowing what overseas banks are doing. So if you're trading Aussie to dollars or loonies to dollars, knowing what those banks are doing. On the flip side, those move markets. And so you have to know it's taking place on the street so that when those factors happen, you can pounce rather than become one of the sheep that gets slaughtered in movement. And likewise, the deal rumors, or if you're trading R&D stocks, phase 2 studies, you need to understand what drives those stocks beyond the chart. And that'll help your chart vision, because you'll understand when those things are going to take place, or when the expectation on the street is going to start factoring those prices in, which will help you give a bias as to how that stock should move. And if your bias is right, then you make a lot of money. And if your bias is wrong, then you lose a little. The point being that as you repeat that time and time again, you wind up the number of occurrences under your investment strategies. If you are solid or well grounded in those strategies and continue to execute over the long haul, you're going to make money. If you're looking for lottery tickets, then this is a completely different conversation. I think, was it HMNY, maybe looking for some buyers you can load up there, but or mine. Yeah,
that's not a buy recommendation, people. That's a joke, okay?
Yeah, do not do that. But my point being, I'm not an investor advisor under FINRA. I have no series blank certifications. But my point being that you should know what you're getting into, right? And so by looking around the environment, by looking around what's driving a stock before you even open a chart, if you do that, you're instantly a better trader than 80-90% of the people that are out on some random website that may start with I and end in hub, looking for buy and sell ratings on 0002 penny stocks. So just be aware of your surroundings, and that instantly makes you better than the average trader.
Exactly.
So that's one. Yes,
I got it. Just because you're such a fundamental guy, you know how to read, the balance sheets and all that stuff. Have you looked into HMNY and their paperwork at all, or you just have kind of a headlines type understanding of that whole situation?
I just have a headline understanding of that situation, because the reality is that the financial statements matter for companies that actually make something and can drive value off of whatever they make or whatever service they push, right? And so my understanding with HMNY is, and this is a headline, I haven't read the article, but MoviePass, I think, is starting to die. And so if that dies, then that's, to me, either the end of HMNY, or they'll crush that and they'll turn it into something else, like a dormant public company that another private equity firm could pick up for pennies and use it to drop in assets. That's called a special purpose acquisition corporation, or SPAC. But they could use it to turn it into a SPAC and go do something else. The problem is that if you're an equity holder in a company that, like HMNY, and they decide to retool it, all outcomes at that point are bad, because you're going to get crushed in a cram down to remove the old equity and put new equity in through a new series stock class, or a Chapter 11 bankruptcy, whatever. Or you may get extremely lucky. And Dry Ships comes to my mind a couple years ago, where it spiked from, I don't remember all the splits, but at the time I think it was $5. It rode up to 150, and 2 days later it was at $5 again. But that's spinning the roulette wheel. That's not trading. That's not investing. So companies like HMNY or mine, or there's 1,000 penny stocks. That's not a story of the investment or the financial statements whatsoever. That is a pure story of Kool-Aid, and that is all it is.
Okay. Because I was just curious, because obviously as we speak right now, and when this airs, it'll still be, I'm sure, in the news, but there's just so many people that, the company is very clearly having problems, cash, funding, hence why they're selling so many shares. But I was just curious if you had looked at any statements and could just give like a brutal assessment of things. But I agree. Let me ask it this way. Let's say that MoviePass actually succeeds. Given all the shares that have been dumped into the market right now, it's like down at 3 cents. Even if the MoviePass succeeds, they would have to succeed so much in order to, get the share price up to where a lot of people would be okay, that a reverse split would probably, do you think that would probably happen regardless, even if, the whole MoviePass business model ultimately works out? Or could people that are buying, let's say right now at 3 cents, actually, let me put it this way. Could HMNY ever get back up to, let's say, $5 a share without a reverse split, given how many shares they've dumped, which has been a lot?
Well, I mean, sure, it could happen. I could go win the lottery today, but that would involve one of my friends buying a lottery ticket, scratching it off, giving it to me, and then I just happen to see that I made a few $1 million on it. My point is that it's good to have goals, but those goals need to be grounded in realism. And so if you're out buying a 50 decimal stock and hoping it's going to $1, sure, that has happened before, but if that's your ticket to retirement, then I hope you go to REI and buy a tent, and you've got a good place picked out in, say, West Texas, because that's your retirement, right? The point being that there are very few instances that I can think of where a stock has even gone down below a cent and has rebounded back to a couple dollars. Has it happened before? Sure, but it's very rare. Yeah, the ones that come to my mind where you've seen a rebound happen and it's worked out, or you've seen a reverse split work, or Bank of America when it got down to, I think, 98 cents during the last financial crisis, and I haven't looked at BAC in a while. It's probably around $30 now. And Citi, when it did I think it was a 10-for-1 reverse split. I may have the numbers right. It's 5-for-1 or 10-for-1, but it split from 5 up to 50, and it actually held. But those are brand names that people know. They have a lot of different revenue streams. They have hard assets. I mean, those companies aren't going anywhere. When you look at HMNY, and again, I haven't read financial statements, their one asset that I'm aware of is MoviePass. If MoviePass dies, that company dies too. And so if you were to decide to go long and strong on HMNY, your investment thesis is MoviePass has a lot of value that the street doesn't know about. The problem there is you're telling the smart money, think of big iBanks, think of value investors in hedge funds or in retirement funds or asset managers. You're telling all of them that what they understand about HMNY is wrong. That's a hard thing to do, because you're basically telling a group of top flight MBAs or CFAs or those type of street individuals that they have no idea what they're talking about. That's the fundamental side. The technical side is, here's a chart and it's trading at 333, and maybe you have a short squeeze for some odd reason and you get out for a couple cents. Well, at least you got out and you've got a nice tax loss now, but you still lost money on that trade.
Yeah, and that's
I know that was a big ramble.
Yeah, no, that was good. That's the whole idea, just to sit here and talk. But yeah, that's a great way to put it. Is because you're right. Sure, Kool-Aid spice can happen. Dry ships, that was a perfect one. But like Mike said, pretty soon it was right back down to $5 where it all started. But to sit there and think that, no, not only do I think that some astronomical spike is going to happen, with HMNY 5 cents up to, we'll just call it, $2. Not only do I think that's going to happen, but I think it's going to happen via non-Kool-Aid, meaning like that's based on the fundamentals. Then yeah, that's literally you saying, I'm getting it at this great price because I know more than all the people that Mike listed. And listen, I'm not saying that you're not an intelligent person. Listen, I'm not saying that you don't have potential, but I mean, those people at the big banks and the investment bankers and hedge funds, and I mean, they're kind of like, they're paid in a highly competitive environment to locate stuff like that. So and it's not like HMNY hasn't been in the headline. So I'm pretty sure that they've looked at it, have done all the analysis and said, no, that's fairly priced. Who knows? Maybe they say it's not fairly priced at 3 cents, but that's a great point and what a lot of people, what I failed to, miss when I got into the whole penny stock world was, here is me thinking that I'm finding all these great stocks and it's really an arrogant attitude when you just stop and think about it. I was arrogant to think that I found these opportunities that hedge funds and investment banks didn't realize was there. I mean, give me a break. So there was my ramble on the topic, but yeah, it was. It's kind of funny when you actually just stop and think and break down the logic from the fundamental point of view. Because, like you said, Kool-Aid spikes. You never know. But if your whole thing is Kool-Aid spikes, then like Mike said, there's a lot of tents out there, and apparently West Texas is good for retirement if you have a tent. But anyways, pick up going there. But that was a good little rabbit hole, so I'm glad we went down it.
Yeah, so actually that leads me into another thing to think about too when you're investing is you should know who all the players are on the market before you even go and look at a chart. And that's more a learning point. So analysts are analysts for a reason, right? People that work in iBanks are working in iBanks for a reason. Retail traders that make it are making it for a reason. And so if we continue on the HMNY example for a moment, and again, I haven't pulled up any documents on it, but if it has 20 analysts covering it and 19 of them say strong buy, and you look at the stock price that is completely beat up, then that should be a red flag at that point, because that means either the analysts haven't updated their opinions, in my view, or there's something sitting behind that story, if you will, that makes zero sense versus the stock movement, which that would tell me that's not even something I would be interested to trade as a swing trader or as a fundamental investor. Now, technical trading, that's 100% about the chart, and that's a story of volume and price, and that's all it is, right? And so in that area, if you happen to be able to pick up a couple cents and you look at your level twos and there's nothing fishy going on there, then maybe you can make some money. But if you're trying to ride HMNY from what we say was $003 to $3, hey, it's good to have goals, but that's probably not one you want to have, right? So being aware of what's in the market before you even start looking at a chart or you start thinking about what type of trade plan you want to get into, that is extremely key, and that will save you a lot of money on the market over time. That's a story. I know you do real estate, and I do a little bit too, but it's a story of making money on the buy than it is trying to make money on the sell. It's a lot easier to make money when you get into something than it is when you're trying to exit.
Absolutely. So that's interesting. So just ticker symbol XYZ, 20 analysts, 19 say buy. But then you're saying after that point, you look at the chart, and the chart shows that it's at 52-week lows, let's just say, for example. And that situation, that is you're not touching that one at all then?
Well, it doesn't mean I'm not touching it. You need to be able to read more to the story. Why is it at a 52-week low? Is it because they've missed earnings for a few quarters and analysts just don't want to update for some reason? That's a problem. Is it because they had a bad quarter and it's mispriced, and you can see some volume starting to buy in at the lower lows to put a basis of support in? I might give that a ride, but I'm also quick to release that if I'm wrong.
Okay.
Right. So that's a story of the chart, right? So you have to get into the minds of the fundamental investor or the swing trader again, and these are the people that do look at analyst opinions. These are people that are buying for a couple months to years. If they're looking at analyst opinions and they're saying, yeah, I want to buy because every analyst known to man and 5 I've never heard of all say it's a buy, and you look at the economics of that company and they have hard products that make money, then yeah, if you're willing to hang on for a few years, then that's a potential buy candidate, and you'll pat yourself on the back if you nail the bottom. But you also have to be willing to cut and run if it breaks through a major level of support. So there was an article on CNBC, I think it was last week, where they demonstrated a value investor that bought the top of the October 1987 crash and bought the top of dot bomb in March of 2001, and they strung out his portfolio to today, and he's up as a net investor, even buying at the top of those two areas. But that's a different strategy than technical trading. Right? That's a fundamental retirement portfolio type trade. And if you're looking at analysts that are suggesting for 2-5 years down the road that this is going to be a valuable stock, it's a turnaround story, or they have evolving technology that they're just having to debt finance at the moment to bring to fruition, but they're not showing any forward earnings yet, and you believe in that investment thesis, then sure, you can make trades on that. But if you're looking at HMNY, again, haven't looked at it, and there's 20 analysts and 19 say strong buy, and the other guy says buy, that's a red flag to me. So it just depends. GE may be a better example of that right now. So GE's been beat up, and nobody knows what's going to ultimately happen to GE. But if you believe that they can turn the company around, and there are analyst opinions that you can read that say that that is very possible, then sure, try it out. Assuming that's part of your trade plan. Again, I don't know what your risk return requirements are, what your risk tolerance is. But if you're looking at HMNY doing that, that might be something that you might want to reconsider before you throw money away at something bad. Right. So again, it's just that market awareness of understanding who all the players are, what their motivations are. And once you understand that, now you're ready to trade. Right. So getting that piece, and I would argue, will make you 80% better than all other investors. So once you understand who the market participants are, how they interact with each other, the news cycle, what you're willing to put at risk, well, now you can go figure out what strategies you want to do. And so for me personally, I look for a few strategies. The first thing I look for is potential swing activities in value investing. And to me, that's the easiest trade you can ever make, because in English, that means mean reversion or rubber band. And that essentially means that a stock over time on a momentum trade is going to continue at momentum, which means when it goes outside that momentum or outside that straight line, there's opportunities to make money. Now, this is not a cryptocurrency trade or a cybersecurity trade. These are well-established stocks that continue to move up. Think Apple, think Microsoft, those type of companies that they're going to move up more than the S&P 500, and you can get in when they're mispriced and exploit some alpha against that stock, meaning that you're going to make more than your fair share versus the S&P 500. And these can be trades that you're in for a couple of weeks to a few months. And sometimes if you want to do this in a retirement portfolio, you can do it there too. But it's, again, making money on the buy, whether you're going long or short. Now, so that's that's my favorite strategy beyond anything else, because it's just so easy to make money at it.
Now, you find things that are mispriced. What is your definition of mispriced? I mean, how do you go about actually finding that?
Yeah, so there's a few ways. And so the first one is from a complete fundamental side. If you look at a stock that gets hammered or just drinks heavy Kool-Aid right after earnings or after a major news announcement, think an acquisition or a disposition in the company, most stocks in the blue chip world do not move 10% a day and stay there unless there is some fundamental change in the equity itself, right? And so things tend to retest where they previously were. When stocks put in new highs, they tend to retest where they came from. When they put in new lows, they tend to retest where they came from. And that has absolutely nothing to do with how you run a company. That's just the psychology of the investment community. And so if you're aware of that, there are cases where you can buy a bottom and ride back with the sheep to the mean revision, or you can sell the top and ride back with the sheep to the mean revision. You just have to know where the cliff is and get out of the herd before the sheep start jumping off the cliff, right? And so, and there's a few traders that make massive amounts of money on our board doing this, but you're effectively trying to get what's called the meat of the move, which I would say is about 70 to 80% of the move, right? So if you look at AMD is another one that comes to my mind. There's a certain individual that has made some very good money on AMD on our board, and he got in, I don't remember what the buy was, let's say it was $2, and he's been long and strong over, let's say, 2 years as the thing's gone through an ascending triangle. It's consolidated a couple times, it pushes up again, and each time it pushes up, there's a slight pullback to hit the triangle again that makes another high, and it continues to do that for the value that AMD now has in its chips. So that's the fundamental play. But the technical trade is it's in an ascending triangle. And as long as people are willing to continue busting through the top of that triangle and drink the Kool-Aid, then you know where your cliff points are all aboard. When it busts through the back end of that triangle, maybe it's time to take some profit. And if it happens to start drilling for the center of the earth, then it's time to get out before things get too hot. But the point is that that's an easy trade, because that's one of those trades that, like locally say, a Stevie Wonder could see. But it's just so easy to make money because you just dump it in, and as long as nothing nuts happens over a few months, you're going to return a healthy double digits on that stock. And that's just one example. Alibaba is another one. I watch Alibaba quite a lot because I think there's a lot of money you can make on its swing. So if you happen to pull up a chart on it, it retested 165 on, I think it's either Wednesday or Thursday of this week. But it's tested that point a couple times, and every single time it's rebounded into the 170s. And so there's a lot of trades you could put on that. You could buy calls and ride that up, or put on a vertical or a calendar on top. You can sell puts. You can buy the stock outright. Yeah, there's a lot of different things you can do to make money. But as a swing trader or a crowd follower, if you know that at 165 it just does not want to break through there and it's bounced, then you get in. Now Alibaba earnings are next week, and again, I don't have on my chart, but I think they're on Thursday, and I have a position in Alibaba right now, but I also don't gamble, so I will not be in Alibaba going into Thursday. But as long as it wants to keep going up before we get to Thursday, yeah, I'll ride along with the sheep. And if there's a big slaughter on earnings and we happen to go check out 165 again, I'll get in for the next herd that wants to make a run. Yeah, so that's what I mean by mean revision, meaning that if you memorize or if you follow certain charts, and as you become closer to a technical than a fundamental bias, I'm a big fan that you should memorize charts and memorize the periods that you trade, so that you can capture these opportunities. But if you know what you're looking for in a chart and that opportunity presents itself, then you should be ready to pounce, knowing that if that thesis does not pan out, you're going to cut it really fast. But if it does pan out, you're going to make a lot of money.
Yeah, no, that's I fully agree. I'm looking at the Baba chart right now. Did you get in on, was that the 14th? Did you is that when you put your Baba trade on?
Yeah, it was either Tuesday or Wednesday of last week. But
when it went down right to 165-ish. Mm-hmm. Okay. Yep. Yeah, and it bounced nicely right off there. And so that's the charting perspective. So where did the fundamentals then come into play? You just know that Baba is, I mean, they're Chinese. They're, the big thing over there. I mean, but you've explained the technicals very, very well. There's a big history of 165. But now walk us through when you put that trade on Tuesday or Wednesday of last week. What was going through your mind fundamentally?
Well, so the fundamental piece is there are earnings next week, right?
Okay.
So I trade a lot of options. I don't think that's a state secret. So I put on a complex option or multi-leg trade there, knowing that if it drops below 165, I'm going to take a little loss, but I'm out, and that's fine. If it comes back, then we'll try it again. But if it bounces, I'm going to ride that bounce for a while. And one of two things are going to happen. Either it's going to breach the top end. I'm going to make money there, because in this strategy, I cannot lose money if it goes up. The math is with me. We'll get to the math in a moment. But I cannot lose money if it goes up above 165, which that happened. But I also know with earnings coming up, and that's a fundamental issue, I'm not a gambler, and so I'm not going to take that particular trade into earnings. And if I do and I get hurt, then shame on me for being a bad trader and not being disciplined. And if I happen to make money, if I were to take that trade into earnings, then shame on me for getting lucky. Now, that's just not something you should do in that strategy. If you're long and you believe the story that Alibaba is the next Google and China, and Google is not well positioned to participate in the Chinese market because they've pissed off the government so many times, then that's a completely different investment thesis than it's at 165. There's earnings coming up. It's high implied volatility. That means you can make money selling premium. So let's go sell some premium and print money, which is exactly what happened. Okay, so your literal fundamental aspect of it was just earnings. But you're saying that there could be other fundamental aspects, such as you just explained. So that just to show, even in the world of fundamentals, there's all sorts of different fundamentals that you could use. But I hope all you listeners, maybe it's kind of simple, but it is simple. But it makes a whole lot of sense, which a lot of people, to Mike's point, yeah, if you just start to consider this stuff, I mean, you're much further ahead of a lot of people, because, yeah, it would not be shocking at all to see this thing continue to get bought up because earnings are coming. So like you said, the Kool-Aid will be out. The sheep will be sipping on that Kool-Aid, and then you'll just simply remove yourself from the trade right before things happen, and then you can reassess after earnings. So, yeah, no, that makes a lot of sense. Now, earlier you commented on, and it sounds like you're headed there, but you want to basically be the casino. You want to take advantage of those that don't understand math. So, I mean, walk us through
kind of that whole component of, like you were just saying, the math of things.
Yeah, sure. So in the casino, there's a reason the casino is undefeated in the slot machine. And so if you were to walk up to a casino in Nevada or another state to the window and cash in your chips, if you looked at one of the sides, I think it's every state that runs a casino, but I know this is true in Nevada, they have to tell you for $100 that you spend what your return is, and it's not higher than $100 on average, right? And so basically that means that the casino is better than math and you are, meaning that they sell fool's bets to people that walk into a slot machine and just want to hit a button and kill a day. And if you know that and you're willing to kill a day, then that's one thing. That's an entertainment story. But if you don't know that, then there are a lot of people that go bust in Nevada or New Jersey or Louisiana, close to where I live, whatnot. But as a trader, then that also means, if you can equate that idea to Wall Street, that also means that you can set up math plays to where you punish investors or you punish traders that have no idea how to set up option strategies. And so I'm a big fan of setting up strategies where I cannot lose money to one side of the trade, meaning if I'm right and I make money, then I know why I'm making money on the math. If I'm wrong, I still want to make money though. So getting paid to be wrong is what we're talking about when you sell premium. And what that means is setting up trades where you cover one side, but the total premium collected is greater than the distance of those strikes, whether you're short or long. So so there's two ways you can do that typically that are easy to understand. There's other ways, but the two easiest ways are, if I sell a call spread and I sell a naked put, and this strategy's been around for a while. I think there's a couple of terms we toss around on the board that this will become clearer. But if you do that strategy, and let's say that I collect $6, but the width of my call strikes are 5, I cannot lose money if the trade goes up. If it sits in between my call and put, then I take everything. And if it goes below my put, then it can go below to a certain extent. And then if it goes below that, I start losing money. But the point is that you put the math in your favor, in that by not being able to lose money to one side of the trade, I de-risk the trade, but I'm also giving myself ability to manage the trade that a long premium buyer cannot do. And I also get to set the percentages as to how much risk I'm willing to take versus expected return in that strategy. And there's multiple ways you can do that. You can do that with double diagonal. So that can be done either in low implied volatility environments where you think implied volatility is going to increase over time. You can do that to set up earning buys later on. So in that case, you're basically getting paid to gamble, which I do that every now and then if I like a chart. But I think over time, this gets back to the fundamentalist. Over multiple months, the chart's going to move in a certain direction. Then I may go sell a spread, but put a longer spread further dated outside the short strikes, but get paid to make that trade by a few cents. So if I decide after that 30, 45 day window goes by that the setup isn't happening as I would like, I get paid like you would in an iron condor type trade. But if the setup's going like I think it is going to pan out, and I want to gamble on earnings or I want to gamble on an event, and notice I'm saying gamble. This isn't trading, this is gambling, but you're getting paid to gamble, so you're not losing money. If you're setting that type of trade up, then you can stay into trade and see what happens on the event. And if you're wrong, no harm, no foul. Where you lose money in the market is when you are truly gambling because you either don't understand the math or you're trying to put setups in place where you're paying to take the setup and then the setup doesn't happen. And when you look at option buyers, I would argue 2/3 of option buyers are doing that latter piece where they're buying options with the idea they have to be directionally right. And more often than not, you're not directionally right. So you'll hear the concept of occurrences matter in the option world. And all that means is if you're good at math and you're good at setting up investment theses in an option play that make no sense to the buyer, the person that's taking your trade, as long as they don't understand what that math behind that trade is, then you're going to make money over the long haul. We want people that are going to buy those options because those are the sheep we're taking to the slaughter, right? And likewise, if you understand as a buyer that you are in a fight against time and direction to get into an option trade, then you know that you should generally not be buying options from a swing trading perception or perspective, not a scalping, but a swing trading perspective, where you're trying to make money in a few days. So understanding the math behind the options and understanding Black-Scholes or binomial or lattice model or a Monte Carlo simulation, if you're doing multi-legs, and some of that stuff doesn't matter as much, but you should understand the math of Black-Scholes, what the first order Greeks and some of the second order Greeks are before you even go trade options. And then once you understand how those Greek work inside the equations, and you don't have to understand the math or you'd be able to solve for a second derivative equation, but as long as you understand the base math through whatever platform you're trading on tells you, then you can be a successful options trader. That's the secret sauce. And so the second thing I look for is setting up math plays that are in my favor and take advantage of flunkies that just didn't want to study hard in high school or college and punish them for being on the market. And that's a sick way of saying it, but that's the same way banks or other retail investors look at it. We're punishing people for being bad at math.
Yeah, I mean, I personally think you're still being too kind with the way you're saying that. I mean, but yeah, listen, listeners, the market's rigged against you. True, but it's the only reason it's rigged against you is because you're allowing it to be rigged against you because you're not learning some basic math. And to Mike's point, it's not like you have to go out there and take calculus classes, because with the platforms these day and age, I mean, they're going to do the number crunching for you, but you still have to be able to understand the math in the sense of what are those numbers telling me? How do those numbers work together? So that's the math he's talking about, right, Mike? You're not saying that anybody needs to go take a calculus class and then some sort of analytics and statistics and data analysis classes. Nothing like that, right? That's not the type of math you're talking about.
That's right. You don't need to go become a chartered financial analyst to understand how to trade options. But you do need to understand what the Greeks are on the first order and a couple of the second order groups. So again, going back to gamma. So in the world of option trading, if people are long options, you'll hear the concept of gamma capture. And all that means is as a stock approaches the strike on the contract, the underlying option moves more quickly or more violently, or whatever term you want to use there, in a direction versus the approach. Yeah, and so the reasons why you typically wouldn't want to buy options 5-7 days out, or you have theta risk, which is time decay, right? So if I sell you that option, you have to be directionally right in 5 to 7 days, or I take your cash. And then I have what's called gamma risk, meaning that as we move closer to expiration and we move closer to the strike, that underlying option is going to start to mirror the exact movement of the underlying, the stock price or the commodity, whatever the peg is, right? And so by understanding that, you understand when you should get into a position and when you should get out of a position. So going back to math and then bringing the charts in, a lot of option traders for some reason don't like staring at charts. I think that's a fallacy. I think you should stare at charts when you trade options. There are a lot of option traders that think that if you get into a trade and you tear off 40, 50, 60% of the value of that trade as an option seller, that you should take your toys and go home. I'm a fan of, you look at the chart and you say that if I'm far away from the strikes, why would you not stay in that trade? So as an example, if you're selling premium, you're typically selling about 40 to 65 days from expiration, and it's going to take you about 2/3 of that time to tear off half the value. And that's absent to any volatility that's taking place on the underlying. But if you sit in the trade for 2/3 of the time and you're sitting right in the middle of the strikes, why would you not try to camp out for the other third and tear the whole thing off and pick up the extra 40, 50%? That's great return on investment versus the risk that you're taking on. Some people won't do that, and that's fine. It just means that their risk tolerance is different. But that you would be able to sit in that trade longer means that you look at charts, not just the underlying math, because the math is going to tell you that your gamma risk is getting high and you should get out of the trade. And I would argue that if you understand supports and resistances in charts and you understand patterns and technical analysis, maybe you should stay in a trade when other people are saying that you shouldn't. So that piece is more about understanding the math and also understanding what your risk tolerance is as a trader or an investor before you even walk in the door. But once you walk in the door, you have to understand what the math is telling you and what a chart is telling you, and when it makes sense to stay in a trade and when you should cut before things get really bloody.
Exactly.
So that's the math play.
Yeah, that's good stuff.
And so the other things I like to do, speculation. I love speculating, and that's just pure chart plays as a swing trader. And so what I look for, and I know that you advertise 3-for-1 setups. I actually look for 5-for-1 setups, because when I'm right the 4 out of the 5 times, those are typically speculation trades that become momentum trades, and you can follow the herd, if you will, up the meat of the move in terms of throwing out earlier. This is AMD, going back to that. This is Tesla. This is Snap when it gets back to, I think it's 12. Yeah, those type of trades. So you're speculating that support and resistance is going to hold based on the pattern in play, which is typically some type of triangle or wedge, or it's a bull or bear pull that's flagging. And you're saying that while it's consolidating into the predicted move based on the technical analysis, you're going to join in where it makes sense and capture that move. And if it doesn't, then you're going to cut before the next move against you occurs. And so that's why I like those 5-for-1 type setups when I'm speculating. That's not a retirement play. That's pure technical trading, and that's typically swing or even scalping. So you 2 5-minute type traders that are sitting there looking for your moves, looking at volume. You might have a couple of technical indications like money flow or RSI or MACD. You're putting all that together. Here's the chart pattern. Here's my support resistance. And I'm going to go play that, knowing that if I'm right, I'm going to print some serious money. And if not, I'm going to lose maybe $50, $100 at most and move on to the next trade. Right, so that's speculation. And then I also like doing first mover investing activities too. And so what I mean by that is finding companies that have a unique product that have good pricing, where you're going to put a small amount of money in. These are not things where you go roll 10% of your bankroll on, but you're going to put in maybe 1-2% of your net worth at most, and you're going to try to write up the technology. So going back to Facebook, when that came out in 2013, it hit $13. That's a first mover ploy. It's the first social platform that went public. That's Snap when they went public. Those are cybersecurity companies that are starting to look at going public today. That's that type of first mover investing, which is also good for angel investing too, where you're buying into what we do, restaurants and oil and gas assets, where you're betting on entrepreneurs that they're better than the field and they have a proven track record why. So those are my things I look for in the market. Right.
Now, how many positions do you have on at a time between all these? Now, obviously, an angel investment is a little bit different, but I mean, as far as what you described, what is your typical screen look like, in the sense of how many positions would we see on at once, give or take?
So right now I'm pretty light, and that's just because of I don't like the macroeconomics I see in the market. So I've got, I think, 10 on. I'm typically around 30 to 50. And the reason I like to stay above 30 is because statistically that's the number where sample size matters to a set of strategies, right? And so when I've got 30 trades on, if things are moving in my direction, that validates as a statistical test or t-test that what I'm doing makes sense to my portfolio management. We're getting way outside technical trading now. This is portfolio theory. So you can do that either through buying mutual funds or buying ETFs or running your own portfolio. So if you go pick up SPY as an example, you own 500 stocks. That stock by itself would tell you whether what you're doing as a trading strategy makes sense or not. If you own 5 stocks or 5 positions and all 5 go south, it's hard to infer by just that fact pattern alone if your strategy is making sense or not. Now, if you go do that 6 more times, you get up to 30 samples and all 6 times you lose money, then it's time to look in the mirror and ask whether the strategies you're trying to deploy make sense or not. And maybe they do. Maybe there was some Six Sigma or Black Swan event that took place, but most of the time, because a Six Sigma event is over 1 in a million, most of the time it's going to be the person looking back at you in the mirror that's causing you issues. And so that gets back to that grounded discipline and realism that if you're not willing to admit your mistakes as an investor or as a trader, or it doesn't matter if you're technical or fundamental, if you're not willing to admit your mistakes, then you're going to have a very sorrowful time trading on the market or even investing on the market. And that's not to say that I have it all together too. I mean, I make mistakes all the time. I got into, I forget the symbol, but I got into a trade 2 weeks ago that cost me $900 in a day because I misread a chart. And I've been doing this a long time. It happens, right? And $900, depending on how much equity or how many contracts you're trading, that may hurt, it may not, but the point is a loss, right? And so it was more than $100 loss as to what you should be cutting off when things go south on you. To take that kind of loss, is I had to go look in the mirror and say, if I don't do this, then it's going to start getting really bloody. So I cut my teeth and did it, which that hurt, and I'm glad I did, because that would have gotten to mid 4 figures had I not taken that loss. So that was the discipline. But that was a few steak dinners that we got to miss out on because of that mistake. People make mistakes. It's just the traders that make it know when they make a mistake, they need to cut and live to fight for the next battle rather than lose the war on one trade.
And like you said, they need to know who to blame after they've taken that loss. So that's the important part too. And then looking at the time, we'll start to wrap things up. But what is on your screen from a charting perspective? I get the sense that it's going to be pretty basic, but if a listener was sitting next to you and they saw your chart, what exactly would they see in the sense of what you're using?
Yeah, so I keep 3 screens worth of charts, and that's probably atypical. So I have I call it the press your luck board or the bingo board. So that's my 6x6 pack of stocks I am in or about to be in. I mean, I have live orders on that show me on an hour what's taking place on each one of the stocks. And I'm not watching those to say, here's the technical side of what I'm trying to trade as part of a scalp. I'm watching them more for here's the pattern that I think is occurring, and here's the nearest support resist. And if that starts to play out, it gets my attention. So those are live trades. I keep a 4-pack of stocks that I am currently looking to potentially put a position on. And so on that screen, it keeps a daily, a 1 hour, a 15-minute, and a 2-minute. And I do that because I want to see from the technical side who's scalping where. And that gives me an idea based on the level 2s. We talk about hidden orders on a level 2. Well, a 2-minute and a 15-minute chart are pretty good at ferreting out whether there are hidden orders you need to be aware of or not. And then the hour and the daily help me price where I want to go in on entry, depending on what type of strategy I want to put together. And then along with that, I've got a 3rd screen that puts the weekly chart up, and that's to show me any long-term support or resistance that I need to be aware of, or any long-term patterns that if they break, then all hell breaks loose, or the sky's open and you're blessed by a big three-digit percentage gain because it broke through some major resistance, right? And so I'm always looking at all 3 of those at any given time. But what gets to my attention typically is that daily chart on my 4-pack, because that's the one, as a swing trader, I'm using the most to get in and get out of stocks. And then on my other screens, I have what's currently in the order book. I have a TV that's got the news on. Typically, it's on CNBC. And then I will typically have a random window open to read news or sit on multiple chat rooms, things like that when I'm actively trading. So that's probably overkill for most people, but on the daily chart, that alone is enough to trade for a swing trader. So when you look at that, I, of course, have the candles. I still keep the Bollinger Bands on. I have no idea why, because a Bollinger Band only means it's a 2 standard deviation move, which means 1 in every 20 candles is going to be outside the Bollinger Bands, which means, in my mind, they're pretty worthless, but that's just how I was taught to trade, so they're there. Volume is always there as well. I keep the MFI along with the volume as well. And I do that because volume does confirm price, but I want to see money moving into the price as well. So if MFI is moving with volume and price is moving, then that tells a pretty good story of directional bias. And then the next line down, I keep my MACD and my RSI together. Same thing. If they're moving in tandem, then that tells me that that bias direction is correct. And that doesn't mean that when MACD gets down to 15, that's an insta buy because something's mispriced. It's just a indicator that it could be mispriced. And then finally, because I trade options, I keep the implied volatility and the implied volatility rank on another line in tandem those up so that I know what type of plays are potentially available if I want to put an option position on. So those are my screens.
Nice. So if you're sitting there as listening, that's kind of like a lot of stuff. He's got a lot of procedures and protocols. Yeah. I'm sorry, but that trading robot somebody's trying to sell you, or those text alerts that somebody promises you, you're the people that don't understand math, and you're the people that are being punished, and our people are seeking to punish. And I love how that's put, because that's essentially what's going on. But hey, Mike's taking time out of his day to warn you. This podcast has been around. We're trying to warn you. Now, whether or not you listen, I don't know, but I think we would make a strong argument that you kind of deserve to be punished if you hear this and you still decide to say, no, I'm going to go, I got it, I'm going to do my own thing. Well, then when you get punished, don't come crying to us. Don't go crying to anybody else, because you've been warned. So did you have anything else you wanted to cover, or else I'm going to take it to Chez's time machine?
Yeah, so just really quick, the pillars that I think you should have as any trader. First, we'll talk about this on the wrap up too. First, you have to learn. If you're not willing to learn, then the market's not for you, and you will get punished. And it's going to be not just people like me. It's going to be Goldman Sachs. It's going to be my asset managers. There's going to be a lot of people taking your money. And money on the street costs a lot of money. Don't be that person. Secondly, you have to have patience. You trade the plan, let the plan play out, or if it doesn't, cut. But you've got to have the patience to stick with your game plan, continue learning, look yourself in the mirror when things go wrong. I'm not 100% batting average trader. I bat about 70%. But I also don't lose a lot of money on the market because I cut losses when I need to cut them. You need to be agile. And agile means that one trick is not going to make it on the market. You've got to have multiple tricks. So I do scout from time to time, but I don't scout much because my job doesn't let me do that. But I know how to do it. I also know how to swing. I know how to fundamental invest. I trade options, commodities, futures, equities. And I've been trading a long time. And I'm not suggesting that you're going to get there in 12 months, but you can get there in a few years if that's what you want to do. You need to be frugal. And frugal means that you are saving money to go invest or go trade, because you will take losses, and you need to have money available or dry powder to capture opportunities when those opportunities become available. So if you're out spending money on the new iPhone 10 when you just don't have the budget to do that, and then wondering where your money went to trade, there may be some things in your budget you need to take a look at to turn your trading into a business, which is what this ultimately is. This is a business, not gambling. Needs to be scalable. I mean, we don't trade because we want to just trade one stock. I mentioned I keep about 30 to 50 stocks at any time. And those stocks need to be scalable, or those positions need to be scalable, because as you find opportunities that you can make money on something that works well for you, you need to be able to scale more money into more positions over time, not buy red positions and make them more red, but this is more doing what works well more often. You need to be disciplined. We've talked about that. And you need to be real with yourself. So if you're watching E-Trade and thinking you're going to buy your next yacht as to flunk out from high school, that's not going to happen. You'll get punished by people at Morgan Stanley before that ever happens. So you need to be realistic with what your expectations are. But over time, if you do all of these things, you put into learning the sweat equity, you can become a successful trader. And if it's a scalable business model, the sky's the limit. So that's my spiel. All right, time machine.
That was a good spiel. So the time machine,
yeah.
Which I'm kind of curious about, because you seem to have you do a really good job of looking at the positives of all situations. But if Chez were to lend you his time machine, and I know you and Chez hung out, so I'm sure he would give you his time machine, and you could go back to not necessarily when you were 6, but some point at the earlier parts of your journey. What would the pretty much primary bit of advice that you'd give yourself?
Yeah, well, with Ches, I know I wouldn't have went down Mount St. Pat's with him because that was brutal. Or Christmas tree, goalie, whatever those double blacks were in Steamboat. That was painful. I got taught a lesson there.
They punished
for
you?
Me, beatings will continue until morale improves. Morale did not improve on those slopes. Yeah, so for me, it would be going back to the late 90s and looking at the siren song of the tech markets. And so Bitcoin is the classic example today. And this is where I did have some discipline. I'm happy about it. So with the tech market, I mentioned that I didn't quite blow up my account, but let's just say I left the market with my tail between my legs during that time. But Bitcoin, if you looked at it in October, it was around 5,000, 5,500 per coin, if I remember correctly. It spiked to 20,000, and there were a lot of people, and I've got a lot of friends that chased that rabbit up to 20K, got in somewhere near that, and they're wondering why they're sitting on a 70, 75% loss now. I put $100 into an account just as fun money to really test me in trading, well, I'll call it currency, and get some experience on live money, knowing that $100 was not going to hurt me, but it would teach me some lessons if I was wrong. And I did get taught some lessons, but I didn't lose my account over it. And so looking back at the late 90s, I would have told myself, yeah, you can sip the Kool-Aid, but you don't need to binge on the Kool-Aid. When you binge, the next morning's not pretty. And so that's what I would tell myself. Don't binge drink.
That's good stuff, and that makes a whole lot of sense. And that's kind of the underlying theme. Also, I notice is just sipping, but not bonging it down or anything like that. Let's see, what else do I have to ask you? Your favorite? Okay, now we're moving to the fun questions. So, what is your favorite? No, Mike told me don't ask me my movie. I don't watch TV. So I'm gonna ask you this. You mentioned you like to read. So, what is your favorite book?
Oh, that's a tough one.
See, you thought you were going to get off easy. I'm so just
right
not
now,
nice.
I'm just looking around at. Well, no, I've got a lot of favorites. I'm just looking around at what I've got weighing out. So right now, I need to finish this book. I'm reading The Life of a T-Shirt. Can't read the whole thing. I'm forgetting the title, but basically, it walks through how a T-shirt gets made from the cotton farms and goes through the history of the cotton markets, which I don't think anybody listening to this is going to trade cotton. I don't, but it's interesting history. But it goes through how cotton is farmed, how it was sold on A Street in Lubbock, Texas, and how the people buying the cotton from the farmers would rig the market in their favor, meaning they would accidentally set the scales in a certain direction. So again, going back to, if you don't know what you're doing on the market's not pretty, and that's just realism in life. Life isn't fair. But it goes through that, talks about how T-shirts are weaved in China, brought back to the U.S., all the tariffs around them, and then how T-shirts finally get free when they are not sold in the U.S. and sent to other countries, mainly Africa. So that's, when the Bills won 4 Super Bowls in a row back from 1990 to 1993, only they actually didn't do that, but they had T-shirts printed saying that they did. They all were used in Africa to help individuals there. So it walks through that history, but it goes through the economics of a T-shirt, which are very interesting to me as a market participant. So that's one thing I'm reading.
Interesting.
There's another one.
Yeah.
Yeah, and I put these books out on that I'm reading out on your site every now and then on your chat room. So I can do that after we're done here. There's another one that walks through the dark history of what I'll call the 4 tech superpowers: Apple, Facebook, Microsoft, Amazon. Or I'm sorry, Google, Amazon, Microsoft, FANG basically, but goes through how those companies were developed. So if you look at Apple, for example, and you don't know their history, Apple started in somebody's garage in the 70s. Steve Jobs and Bill Gates was attached to that. Bill left later on to start up some small company called Microsoft, right? Or if you look at Google, that started in a garage in California as well. So it shows the companies from humble beginnings to the behemoths they've become today, and all the stories of how those entrepreneurs almost lost their companies on multiple occasions, and walks through the painful side of entrepreneurship. And so me as an angel investor, and I look at investing as a business, and we have some other stuff going on too, I mentioned that I almost lost my portfolio during the dot bomb era in the 2000s. And so it's a good lesson for me to relate to billionaires, which I'm nowhere near being a billionaire and never will be, but being able to relate to those lifestyles and seeing that they had a dream. They wanted to put everything on the line to capture that dream. And they were ultimately successful doing that as an entrepreneur. And so it goes through Jeff Bezos and has a couple pictures of him sitting in front of his I guess it's a 486 because this is in 1999, 2000, 2001. I don't remember the year, but goes through the dot bomb era and shows him trying to sell stuff on Amazon.com when it was only a bookstore. And so that's another book I'm going through right now. So yeah, I'm a big fan of reading those nonfiction market type books because they do teach you things about the market that are still applicable today. And again, it sets that bias or gives you that grounding to become a successful trader over the long haul. And I'm a big believer that if you don't educate yourself and continue investing in your life, then other people are going to catch up and pass you. And I just don't want that to happen to me again.
I like that philosophy.
Those are the two things I've got.
That's good stuff. What was the name of that fourth one or the second one you talked about?
Oh, I've got to find it just a second.
About the history of the Fang ones. Is it the? Because I'm on Amazon right now. I was curious. Is it the 4, the hidden DNA?
Oh, no. Yeah, that's it. It's the 4. Sorry,
okay.
I had it buried. I had no. Yeah, but it's the 4.
Okay.
The hidden DNA of Amazon, Apple, Facebook, and Google.
Okay, I'm looking at that one right now.
I've got. Yeah, but that's a good one. Yeah, so the T-shirt one is called "The Travels of a T-Shirt in the Global Economy." That's a good one. There's another one, and if you've been in the trade room, you've seen a lot of debate on and off around macroeconomics. And so one book I like is called "Naked Economics: Undressing the Dismal Science." And so you'll see in some of our what I'll call late night debates when I'm just sitting up here, and I do watch a little TV, but I don't watch movies. So it's typically like Smithsonian or history or something boring like that that's on the main TV. But once in a while, we'll have a economic discussion, and you'll hear me talk about the power of the U.S. dollar. And so Naked Economics is one of those books that walks through that a little bit. And also walks through financial markets and international economics and how everything plays together.
Nice. Well, I think I'm going to pick up the 4 and maybe that T-shirt one too, and maybe even that because those ones all sound super interesting. All right, now I'm getting kind of hungry, so I'm going to ask you, what is your favorite food?
Ooh, that's a tough one too, because living in Texas, there's a lot of favorite foods. I like steak. I'm a Texan, so chicken fried blank is pretty good. Even if it's chicken fried Snickers, chicken fried Coke, which you can get at State Fair, that's good stuff.
Interesting. I would like to try those. I'm just gonna have to get down to Texas again at some point. And then finally,
well, the State Fair is in October.
Is it? All right.
You can go there. You can watch a couple of real football teams, Texas and Oklahoma.
Oh, here we go. I'm not even gonna take that bait. I'm not even gonna take that bait.
Let's take it for a strike. There you go.
And then finally, what do you like to do for hobbies? I know you mentioned skiing, but what do you like to do other things outside of?
So I ski. My wife is a big Disney freak, and we're not on the opposite side. So those are our singular trips. We do travel quite a lot. Sports, especially college football. I'm a massive college football fan. So if you've seen my trading setup, you know that there could be 20 games going at one time on random college Saturdays, and I'll watch Division III teams play. That's fine. I like music as well. I wish I had more time to do that, but unfortunately, that's the one thing I've had to let go just because of the amount of time it takes to practice to be good. So those are the things we do. And then I also I'm heavily involved at the University of Missouri and at Rice as far as mentoring MBAs and trying to help out the teams there to become better institutions based on what I've learned in my professional practice. So I sit on a couple of advisory committees there too, and that keeps me a little busy as well. And then I do a lot of mentoring for up and coming CPAs and my team at my workplace as well. So all of that keeps us pretty busy.
Yeah, I was going to say, all right, now I'm buying and going along the premise and understanding of why you just don't watch movies, because it's simply a lack of time. So that makes sense. And then finally, 3 words, and these 3 words, and you kind of did this with your pillars. So, I mean, we can just use those if you want, but 3 words to describe that you would use to describe and associate with, a successful trader, or what it takes to be a successful trader.
Yeah, so the 3 phrases I do: 1, lifelong intentional learning. I've talked about that a lot. So if you're not willing to learn, you're not going to make it as a trader. So learning is number 1. Steadfast discipline is number 2, meaning that if you're not going to follow what you learn and invest in yourself in what you learn, you're not going to make it as a trader, and you're not even going to make it as a successful business person in life. And then finally, the third one's grounded realism. So if you're not realistic with your expectations and what you can do and not looking for opportunities to improve, you may be good now, you're not going to be good tomorrow. So the 3 words: learning, discipline, realism.
And they have nice little slogans that go along with each one. Well, awesome. And I should say that welcome to the 2-part club. I think you're in an elite few. So welcome aboard. And I feel like there's still a lot more we could talk about. So maybe, we will try to have you back on another podcast at some point. But just for listeners' sake, this is how great our community is. It's a Saturday, and Mike took time out of his busy schedule on a Saturday to hang out and just chat, share everything with us. So that's the type of people we have, and I thank you for that, Mike. So thank you very much for hanging out. And I'm trying to think. Do you have any final words, or just something like "learn or else I'll punish you"? Do you have any final statements, threats, anything?
I think I've talked a lot. So just be patient, learn, discipline, be realistic. You get those things right, everything else falls in place.
Awesome,
you screw up those 4 things, it's going to be very painful.
It is. And I concur. So thank you again, Mike. And before we all go, for you listeners out there, final few things. If you are listening on iTunes or any of the other podcast players, make sure to subscribe. And especially on iTunes, if you could leave us a rating, that really helps us out, goes a long way. So we would appreciate it. If you're listening on YouTube, make sure to check out the rest of the channel. There's lots of other videos, live trades, quick tip videos, there's vlogs. So a good variety of things. And then finally, if you're listening at claytrader.com on the show notes page, make sure to click that share button. Leave us comments. We will read them. We will reply to them.
This has been the Stock Trading Reality Podcast. Thanks for taking the time to hang out. To learn more about Clay and the Clay Trader community, including the trading team, premium training, and more, visit claytrader.com.